National Homebuyers Month. My name is Marva Morris, and I am your Central New Jersey Realtor moving you forward. Hello and welcome back. It's day 14, and we're diving into Mortgage 101. By now, you know about different loan programs from day 7, but let's demystify some mortgage terms. You'll hear fixed versus adjustable rates, loan terms, and points. Don't worry, I will keep it simple and straightforward. So, what I'm going to start out with is a fixed rate versus an adjustable rate mortgage. So, a fixed rate mortgage has the same interest rate for the entire life of the loan. If you lock in a 30-year fixed at, say, 6%, you'll pay 6% interest every year, and your principal and interest payment won't change. This is great for stability and budgeting. More first-time buyers go with a fixed rate for peace of mind. An adjustable rate mortgage, which is called an ARM, A-R-M, has an interest rate that can adjust after an initial fixed period. You'll see them described as a 5-1 ARM, 7-1 ARM, etc. What that means is that the fixed rate is for the first 5 or 7 years, and then it can adjust annually. Now, ARMs often start with a lower rate than a fixed loan, which can make payments initially lower, but after that fixed period, the rate can go up based on the actual market. So usually they have caps on how much they can go up per year in total. Now, ARMs can make sense if you know you might sell or refinance before the adjustable period ends, but they carry more risk if rates rise. For first-timers planning to stay long-term, fixed is usually the safer bet. Now, we also have what we call the loan term, which is 30 years versus 15 years, or there's some other ones. So the 30-year mortgage is the most common one. It spreads your payments over 30 years, makes the monthly payment lower, which helps with affordability. The trade-off is you pay more interest in total over the life of the loan. You do build equity a bit slower, but that's okay. Most people choose a 30-year fixed for the lowest payment, which is great. If that works for you, it works for you. Now, a 15-year mortgage, you pay off the home in half the time. Now, your monthly payments are higher because you are paying the same amount off, but faster, but you'll pay significantly less interest overall and build your equity quicker. Now, if you can afford the higher payment, it's a great option, but many first-time buyers stick to a 30-year, and maybe you refinance it to a 15-year later when your incomes are a little higher. Now, there are also 20-year and 25-year programs, but they're less common, and some lenders may even offer a 40-year loan, but that's relatively rare, and often it's a specialty product, so not everyone gets to take advantage of that. So I want to kind of discuss next mortgage points. Now, these are discount points. This is a fancy term for buying down your interest rates by paying more upfront. So 1 point equals 1% of the loan amount, and it's paid at closing. So, for example, on a $300,000 loan, 1 point is $3,000. In exchange, the lender reduces your interest rate. So how much the rate drops per point varies, but you could say go from, say, a 6% to a 5.75% by paying a point. Should you do it? It depends. If you have extra cash and plan to stay in the home a long time, a lower rate can save a lot over time. But if cash is tight for you, you might move in a few years. So paying points might not be worth it. Me and your lender, can calculate the break even. Often, if you recoup the cost in interest savings within approximately 5 years and you'll be there longer, it's worth considering. Now, I want to kind of talk to you about locking your rate. When you're approved for a loan, you'll have the chance to lock in your interest rate. Now, often that's for like 30 to 60 days around the closing time. Now, because rates can fluctuate daily, in the current market, rates have been a bit of a roller coaster. So some experts expect them to ease down a bit, but nothing's guaranteed. So if you like where the rate is, locking it protects you if the rates jump higher. Now, if the rates fall, there's sometimes float down options, but you got to check on that because it's lender specific. So check with your lender. Now, a note for New Jersey. New Jersey doesn't have a special mortgage types beyond these, but one thing to remember in New Jersey that property taxes are high. We'll discuss that around day 18. Higher taxes can impact how much home you afford because taxes are included in your monthly payment. So when choosing a 30 versus 15-year loan and you're deciding on that higher price home, you have to factor in the taxes, the real estate taxes, and your insurance too. A good lender will include that in their estimates. Now, I know this is a lot of jargon, but you don't have to memorize it. That's what your lender, and you know who, are here to explain and advise. So the key is to choose a mortgage that fits your budget and your comfort level. For most, that's a fixed rate and a longer term for stability. Now, if you have questions like, should I do a 30 or a 15 year, or is an ARM risky for me? I'm happy to talk you through it. Just give me a call or text me. You will see my phone number in this post. I can also connect you with a mortgage pro who will present options in plain English. All right, you mortgage whizzes. Next up on day 15, we tackle an often surprising part of buying, closing costs and how to handle them. See you on day 15. Once again, my name is Marva Morris, and I am your Central New Jersey Realtor, moving you forward. Happy, happy, happy National Homebuyers Month.